So Wayne, there we go. That's Quibus's view on the market reaction.
I mean, I'm a bit more worried longer term on Kumba because if one resource, there's serious supply coming on stream in about 2 years' time, 1 year, 2 years' time. I mean, serious supply. If China doesn't grow at 8% plus, there's going to be a very big surplus of iron ore in the world, and then that price is going to come under severe pressure. I don't think it'll hold $100 a ton. And under that scenario, we don't own Kumba. We worried. There's not nearly as much supply coming on in copper, all the other commodities, but iron ore, there's big supply coming.
BHP, obviously the world's largest miner, big plans there. They have said that they are going to relook some of them.
They will.
Going ahead with
So maybe the scenario will change because all the big producers are saying, this very rosy scenario we envisaged 2 years ago is now not coming to fruition. It's disappearing in front of our eyes. But Kumba still worries me, I must say.
It's rallied 20% this year, the stock price.
We have been so wrong.
And it's been the third best performer this month.
We have been so wrong on Kumba for a long time now because this has been a seriously strong share. But our big concern was always they got 50% margins. I mean, if you can mine something and make 50% margin, every person who's got even a half a chance of opening up an iron ore mine is going to do it because the margins were just so huge. And now we see,
what about the
net result of it.
What about short-term traders? If you're looking at that shorter-term horizon, you're looking at the share price having fallen back by 3.75% today, 560 a buy it all.
It's small in the bigger scheme of things. I suppose if you're a real day trader, and you can maybe give it a go there. Yeah. But look, I think China will have better growth figures by the end of the year. Under that scenario, you can't be negative on resource shares in general, although Anglo-American, Billiton, I think, are much better value than Kumba.
And in terms of Anglo-American, just in terms of news flow, yes. Anglo-American is saying that they've got the final regulatory approval to buy De Beers from the Oppenheimer family, and now they have to sell. They have to put that up to
half
sale
of it up
for
to
the
government. Well, we see. I don't know if the Botswana government has got money to buy it. They probably have, but we'll have to see what happens there. But Anglo-American is actually very interesting. Look, De Beers is small in Anglo's lives. I mean, 20 years ago, it was half of Anglo-American. It's actually very, very small in Anglo-American's life now. But they're saying luxury goods really seem to be working in China, and diamonds are luxury goods. So let's own more of this.
Yeah, it's interesting because you get such mixed views on the diamond space specifically, but Anglo-American clearly showing that they're committed to diamond and the diamond sector.
I personally don't like the diamond side because there's massive supply. I mean, there's actually an incredible volume of diamonds available in the world.
And also people who are selling their diamonds to use it to pay off their mortgages or something. There's that recycled market.
Diamonds are worth a fortune, and diamonds are a fantastic investment until the day you try and sell your diamond. Then you find that it's actually not that good an investment. So people will value your diamond at an astronomical price, and then you say, well, actually, can I sell my diamond to you at this price?
So I should keep all the diamonds that I've got in my cupboard there.
Diamonds are bought and worn for very good reasons, but they're not investments.
Anglo-American right now.
I think Anglo's is really, really cheap. Look, all resource shares, earnings are coming down. We know this.
For how long? I mean, how many more profit warnings are we going to have coming through?
It'll depend entirely on China, but you know.
But you say China's going to look better at the end of the year.
You'll know whether profit warnings are coming through, not because we know the gold price every day. We know the oil price every day. We know commodity prices every single day. So if they carry on going down, there's more profit warnings. But Anglo-American and Billiton, when you look at their price earnings ratio, they're currently at 7, which is incredibly low. The reality is it's probably 10, which is still very, very low because earnings are coming down. Maybe 20 odd, 15, 20 odd % at minimum for these two companies.
So as we were saying, the world pricing in an Armageddon type scenario in terms of a fall off in demand.
And I don't think an Armageddon is going to happen.
And that's not what's going to happen. So
we'll see a fall off, but not a disaster.
What about the resources space? I mean, Imperial has been a standout on the market.
It's been very good,
are you buying into that rally? Do you think it's justified?
Imperial still looks quite good. Motor vehicle sales look good. The PE is not too high on Imperial. There are cheaper shares around in the industrial space. I think Bidvest is a better priced share than Imperial at the moment. Maybe you can go for some of the building and construction shares if you're a little bit brave. But Imperial doesn't look massively overvalued at this price.
Yeah.
So, stay with it. But I think of the top 60 shares, I think Imperial's been the best performer this year, followed, interestingly enough, quite closely by FirstRand.
Yeah, and that's another one. Big volumes moving through FirstRand, and FirstRand obviously in the second spot when it comes to key banking. Is that correct? Second largest bank.
It depends on how you measure it, but it's something like that. Yeah.
So would you be buying FirstRand over Standard Bank right now?
Probably yes. FirstRand's going to show good earnings when they come out. I don't know, they come out in about 2 months' time or a month and a half time. FirstRand will show very, very good earnings, but you've got to say...
As they did last year.
Yeah, or we've got to say is a 14 PE. It's getting a little bit rich now. I mean, I've been a great proponent of the banks for, I forget how long now, and we've had seriously good payoff this year other than the ABSA disaster a week or two ago. We've had very, very good payoff from the banking side, but FirstRand in particular is not that cheap anymore. It's not time to sell yet, I wouldn't think, but it's certainly not a cheap share anymore.